Hello and welcome to today's episode of Pivot to Profit, where we help entrepreneurs just like you keep more of your hard-earned money. I'm your host, Pam Jordan, and joining me today is our tax queen, Alexis Sidney. What's up?
Hey, what's up, everyone?
Today, we're going to talk about what are some things that business owners often miss when it comes to taxes and profit. But before we dive in, if you are a founder, business owner, and you are overwhelmed by your numbers, overwhelmed by taxes, don't know where your money's coming from, don't know if you're doing all right, we would love to help you at Pivot Business Group. Just go to pamjordan.com, hit schedule a call. Our team can talk to you, make sure that we're the right fit, and help with your bookkeeping, your CFO, forecasting, your budgeting, your cash flow, your tax strategy, help you get all of it knocked out. So just go to pamjordan.com to reach out to our team. All right, Alexis, today is a great topic because it's something that we see every day. What are some common things that business owners miss when it comes to taxes and profit? What are some mistakes that they're making? And I've got a quick story before we dive in. So
Go
this
ahead.
smoothie is my lunch because that's what I had time for today. And so I walked down to my smoothie place, and the owner and I have started to have a relationship, just talking about business and whatnot because he knows who I am and what we do. And he's like, oh, yeah, we really need to do something with our business and taxes. It's just overwhelming. And I was like, okay, well, what you got? And he's like, oh, we're still sole proprietor. And I'm like, okay, well, you're paying 15% more tax than you need to. I'm like, okay, well, here's what you do. Here's the kind of savings you can look at. And I was like, okay, well, how are you compensating your team? And he's like, under the table. And I was like, oh man. So every dollar that you're paying them is actually costing you $1.30. And he's like, what? And I was like, because you're using after-tax money to pay them because they're not on payroll and they're not contractors. So it is amazing how often we run into business owners, even just while I'm getting my lunch smoothie, that are just making huge mistakes. So Alexis, let us
Wow.
have your tax tip for the day, and then we can dive into the story and all the amazing content.
Well, definitely, some of the most common ones that I see, first of all, is mileage and the vehicle usage. I can't tell you how many times that, business owners are like, oh, I didn't bother to track that. Or, yeah, I use my car for, business and, I travel, but I don't track it. And I'm like, that is just easy breezy, money missed deductions right there. And it's so simple because most of us drive our car wherever we go. And a lot of times it is for business, especially if we're working. And I think for me, I see it being one of the most missed ones is because it's not captured in the bookkeeping system. So it's like, gosh, I got to do something extra.
That
But
makes
nonetheless,
sense.
yeah, that's definitely number one. The second one that I always see a lot of, especially when we get a new client, and I always go to see is the home office deduction. A lot of us, while we have our office spaces, our co-working spaces, or wherever, if we venture out of the home, we do work at home. I know I do. And a lot of times they're not taking advantage of the home office or they don't know how, it's just not done. So that's definitely another common misdeduction that I see. Paying kids, I can't tell you how many times that we get clients and I'm asking like, how old are your kids? And they're like, yeah, they're teenagers. And I know they're in their pocket because my three little ones, I feel like some days walking out the door, I didn't spend $300 in the morning. It's not even 9 a.m. on these three kids. So I see that a lot. Like, I'm like, you don't have a plan. Your kids aren't hired in the business. No. And that is ginormous because this year alone, the standard deduction is $15,000. So that's the max you can pay the kids without putting them on payroll and, having them be employees of the company. And when you start timesing that times the number of the kids we have, like those are huge deductions. So those are pretty common ones that I see. And then another one is startup costs. So we always talk to business owners, or I'm always talking to people and they're like, hey, I'm starting a business up, but I'm not going to claim anything because I didn't make any money. And I'm like, wait a minute now. I know you didn't make any money. And I know this business is new and on the ground, but I know you spent something. I know you spent something.
Even incorporating cost a couple $100. Like that.
Right, right. That part, or a website, or I don't know, but you spent something. And I always see that they do not claim any of the startup costs. So you are eligible to claim up to 5,000 of the startup costs for that first year of business. And if you spent more than that, it is amortized over a certain time period where you can claim the additional each year going forward. So those are the few common ones that are just alarming to me that I see off the top with clients.
Okay. I love it. I love it. Those are great. And it's amazing how many times business owners just don't know because they're just head down in their business, working, doing what they, are love to do, helping their clients, but they're completely missing the mark on these deductions. So let's talk about my smoothie guy. So first off, they have a physical location that people walk in and out of, a storefront where they sell smoothies, and they are still operating as the sole proprietor. Hit me with it.
Wow. So that is, and I'm hoping they have an LLC, and it's just not. Oh my goodness. Oh Lord, help them.
I tried.
Yeah,
But break it
let's
down for
start.
our listeners. What kind of exposure does he have here?
Well, he definitely has a liability exposure. If there is no separation between your personal and getting that liability protection, where you go and get incorporated, and now the business is looked at as a separate entity versus your personal. If anything was to happen, especially in a food establishment with people who are working there, a customer comes, slips and fall, and there's no separation between your personal and the business, anything you have, oh,
They're coming for your house. Let's just be
what?
clear. They are coming
Oh,
for you.
it is mine now. Wow. Okay. Well, that is number one. That is the biggest one of all. The next thing is the tax consequences, because they're not taking advantage of being in a different tax status, and depending on the revenue, I'm sure just depending on where they will want to try to look at where their numbers are to elect a different tax status, assuming they're profitable. They have people working there. We're going to say they're employees, or should be.
We'll get
Um,
to that point.
that part. You want to optimize your taxes. And then that way, by you electing to either become an S Corp or C Corp, it opens the door to other strategies, because now essentially you're not just a business owner, you're an employee of the company and you're owning the business. And that opens the door to you, because if you just stay a sole proprietor, you're not an employee. You can't write your salary off. That was another one I see that's a wrong thing. I see people writing their salary off, and I'm like, wait a minute, this is not right.
You're not an employee. You
You're
cannot.
not an employee. You can't do it. So now you're missing out on tax deductions that you can optimize on, have you have a different tax status by the IRS as an S Corp or C Corp. So that's another thing that is a disadvantage with this picture right here. And then the other thing is the employees, or I should say the people that work there that should be employees. You never know what types of people you're hiring. And there are work opportunity tax credits when you do have an establishment. So I know a lot of times you can hire veterans, or you can hire disabled individuals, or just people who may have experienced some trouble in life, a felon status. Everyone deserves a second chance, a third, fourth sometimes. Um, but nonetheless, if you hire certain individuals and they're actually employees, you can get a credit for hiring these people. So if you don't have your team set up the right way and on paper the right way, you're losing on credits that could essentially put money into your pocket. So yeah, that's a lot right there.
I know. And the thing is when if you have an establishment and you have people working for you and they are your employees, you need to treat them as employees. We've done a podcast around payroll and setting up payroll. But if they're contractors, that's one scenario. If they're on payroll, that's another. But either one of those scenarios, you can deduct that as a business expense because you either give them a W-2 at the end of the year because you're deducting payroll taxes, or you give them a 1099 because they're a contractor. But what they're doing right now of just paying them, that's not a business expense.
Yeah.
I walked in there and there was 5 people working. No one was on payroll. All 5 of those people, the cost to pay them is not a business deduction because they're not handling payroll properly. So y'all, huge. First, he's overpaying on taxes. Second, he's not protecting his assets. Third, his tax strategy is bunk because he can't even write off these expenses. It's
Right.
ridiculous.
Yeah, and then a topper to that, I don't know what the books look like, but if he is deducting these expenses and there's no record of the filings with the IRS or even 1099 contractors, which I'm sure they're not, um, the IRS can come back and redo the taxes and disallow that deduction if it is there. And now you're adding to your tax bill because you didn't do the right thing and take the right steps to even be entitled to that deduction.
Yeah. Like it's bonkers. So here's the thing, guys. If you are a business, you need to operate like a business. So if you want separation between you and the business, that's a good thing because as asset liability wise, protection, tax wise, so much better. The other piece with this is you want to make sure that your banking is different and that your money is different and that you track it separately. A huge mistake that we see business owners make is mixing personal and business all the time. I have seen everything from pet grooming to dental cleaning to all kinds of meals to adult entertainment to crazy shoe shopping on business credit cards. Guess what are not ordinary and necessary for you to do your business? All of those things. Your dog's grooming bill is not a business expense. Like your shoes that you wear all the time are not a business expense. So make sure that if you are going to not have a hobby, but actually have a business, you act like it. And your business has a business checking, savings account, credit card, and your personal checking account, savings account, credit card. Make sure those are separate. It is amazing. And I'm not talking about small businesses. I'm talking about high 6-figure, 7-figure revenue businesses that are mixing this every day. We literally, it was probably 2.5 years ago, we did a really large cleanup for a client. They were doing over 6 million. And we found 6 figures a year in personal expenses that they were running through the business that we were like, okay, super creative, good effort, A for effort, but 100% not ordinary and necessary write-offs for your business.
Right.
So we had to take all that over $100,000 off of their books as business expenses and put it to distributions. And then they got a surprise tax bill because now they had a higher net profit. And they were like, what happened? I'm like, those things aren't business expenses.
Yeah, it's amazing what people think of or think they can write off with their business as personal. So yeah, it's being lazy is what it is. It's being lazy, just swiping that business card. Like, hey, it's just the money is there. I know it's there. Let me just swipe it and deal with it later. But you're right. Don't commingle. It just makes it harder for you to manage and cost more because now you got to fix it up. So yeah, no
Yeah.
good.
Yeah. So one of the other things is entity type, and we've got a whole podcast on this, so we don't need to dive too big in to it. But Alexis, just give us a high level of why it matters to have your business set up the right way when it comes to tax purposes.
Yeah, well, definitely. With the LLC, again, that just gives you liability protection. So, like we just said with the business owner we were just talking about, you're just covered. You have some protection. Your business is separate from your personal. But however, like the situation we just talked about, if you're running and commingling your personal assets or personal, funds into your business, you pierce the corporate veil and there is
Okay,
no
pause a minute.
separation.
You just said a key word here, piercing the corporate veil. I'm going to say it again. Piercing the corporate veil. It's something you don't want to do, friends. Explain what that is.
Yeah, so what that means is commingling, piercing the corporate veil means that you have pretty much dismantled your separation. So if something was to happen to you, the IRS was to audit you, they're looking at you, your personal and your business as one. So I've seen it happen in audits where business owners say they were a business, which they were, but on the same time, they were commingling funds because when the IRS comes and audit, they're looking at everything. Don't think you're not going to give them a statement or you're hiding an account. They can go pull it and get it from the bank themselves. So nonetheless, in this particular situation, they saw the commingling. And so anything, and for this business owner, they actually had a regular W-2 job. So that was income. PayPal, Cash App, everything was income. Business stuff was income. And it was like, what in the world? So that's piercing the corporate veil because they're looking at everything as one thing. And if you can't justify the separation, like, no, this is truly my paycheck. This was my reimbursement check from my job. This was my mom sent me some money and not business income from Cash App. If you can't go down that line, everything essentially becomes income and is taxable and it's a mess. So you don't want to do that because you definitely open the door up. And then from a legal standpoint, if they see that there's some commingling and things of that nature, instead of whoever may be trying to, sue you or for whatever, they can come after the personal stuff now where if you didn't pierce the corporate veil, it's like, hey, my business has nothing. Sorry, I don't have nothing to give you but whatever insurance. But when you pierce it, it's like, no, you got a house, a car, you got a 401k, and I want it all.
Yes, 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 yes. All right, so let's talk about bookkeeping. Look, nobody that's an entrepreneur starts out and says, do you know what I'm excited about with my business? Bookkeeping. No one says that. I get it. Us numbers people, we love bookkeeping. It makes us happy. We love to reconcile. We love to code. But the rest of y'all, I get it. It's not your favorite. But Alexis, kind of help us understand what happens if you don't have your crap together. What happens if you don't have real-time bookkeeping? What happens when it's tax time and you have nothing?
It's a nightmare. Goodness. I need a drink. Oh gosh. Yeah, when you show up to tax season, not tax team, tax season with no books, like you're setting yourself up for major failure. I always tell clients, sometimes I can't even remember what I had for dinner last night, let alone when I get to file taxes next year. Like I'm supposed to remember everything that happened from last year to now. It's impossible. You're going to miss income, you're going to miss deductions, and then you're possibly overpaying on taxes or underreporting on taxes for that matter because you don't have the financial records. So I tell business owners, I understand like all of our businesses are different levels. Some of us may be just trying to get by, do something. I prefer using an accounting software, QuickBooks, Zero, something professional. However, if you just don't have, those type of transactions, you still need something. Start with you an Excel spreadsheet. Get that stuff in. Bank statements are not accounting records. I always have to
I do not understand. Like, I've talked to a million, like someone doing over $1 million, and I'm like, so let me see your books. I need to see your financials and what's going on. Oh no, I just have I put everything on my Amex. Your Amex is not a financial report.
Yeah, it's a mess. Like you are prone to overpay or underpay, miss deductions if you do not have books. And then another thing is like you're a business owner and you should know your numbers so that you can see what's going on in your business from month to month or even quarterly. And if you don't have financials, for the life of me, I just don't understand how you're even understanding if your business is profitable, not profitable. Like, I don't know what kind of math. We probably need to learn it, Pam.
There's something. I tell people all the time, just because there's money in the bank doesn't mean it's your money.
Right. That part. Yeah.
As a business owner, just because there's money in the bank, you can have payroll coming out, your rent's due, you can have your Amex bill about to be drafted. So just because you look in the bank, your business bank account, you're like, yeah, I'm sitting on 20 grand. Look at me. I can go shopping. No, like literally that 20 grand could be spoken for. And if you don't have bookkeeping records to tell you where that money is going to be going, you can spend it and then those bills ding and then you get NSF fees because you spent all your money.
Yeah, it's crazy, but yeah, definitely get something. I don't care if it's a piece of paper, just do something and not show up the tax time and then it's important because you need to file taxes and now you're scrambling. I can't tell you how many clients that I've encountered over the years where they have no financials and it's like they'll delay years and years and years of filing because they don't do what they need to do. And it's like tax is still not filed 3 years later because I'm working on the business expenses. And I'm like, okay,
How are you supposed to remember 3 years ago what you did with
I
your
have.
business? Like there's so much that you're going to leave. So look, if you're just starting out, get an Excel spreadsheet, make sure you have a business checking account, not your personal, and keep track of the money that's coming in and keep track of the money that's coming out. Once you start to get some money coming into your business, it's time to up level. QuickBooks Online is what we recommend and what all of our clients use because it's the easiest, it's user friendly. It plays well with a lot of other softwares. So if you have an inventory software or a point of sale, QuickBooks will talk to most of those softwares. But then there's a point where if you as the business owner are worth more than $20 to $30 an hour, it's time to outsource the bookkeeping. Because I
Yes.
see this where we recently brought on a client that's doing multiple seven figures. And I said, okay, well, who does the reconciliation? And they were partners. And he said, oh, well, I do. And I'm like, how much are you worth an hour? He's like, oh, my billable rate is $400. I'm like, that's fantastic. So every time that you're reconciling, you're losing $380. Can you please stop doing that? And he's like, what are you talking about? It's like, your time is worth so much more. Why are you doing a $25 an hour task?
Yeah, and just to add to that, I was looking at a client's return the other day and, forecasting or projecting what they're owing. And they're like, there's no way we owe. We didn't make any money. And I'm like, well, the books don't say that. Come to find out, they were doctor doing their own books. And nonetheless, they doubled the income because they didn't know what they were. And so that's a whole nother thing. Like your skill set is your skill set. And we try to be bookkeepers and tax strategists. Let us professionals do our job just like we go to the doctor when we're sick. because we need you. So yeah, just stay in your lane. That's another thing.
Yes, do what you do well and delegate the rest. As an entrepreneur, when you start out, you're the janitor, the IT, the sales, the marketing, the HR, everything. I get it. But once you start getting $5,000, $10,000 in revenue a month, it's time to level up. And when you start getting 20, 30, $40,000 a month, it's time to level up because you can't operate your company as a $2 million company like you did at 200,000. You need to up-level your team. You need to have real-time bookkeeping. And by that, I mean, you need to have a software like QuickBooks that's syncing to your business bank account, that someone's coding your transactions on a weekly or at least monthly basis, and that you're getting reports by the 15th of the month. If at this point, it is after the 15th of the month, and you have not seen your P&L and balance sheet for last month, fire your bookkeeper and go get another one. Go to pamjordan.com. We would love to help you. There's lots of resources out there, but it is time to up-level your bookkeeping. You cannot get outside money. You cannot make sure your taxes are filed properly and on time if your bookkeeping is not accurate. One of the things that Alexis and I, in our process that we do with everyone that comes to our business, is we do an analysis. And part of that analysis is rating their bookkeeping. And y'all, 95% of every business owner that comes to our firm, there is something wrong with their books. We have never in 8 years had someone get 100% on their bookkeeping. We had just this week, we had one firm that's doing 3 million. Her books were in the 60 percentile. No, that's a lie. She was a 58. You get another client that's doing almost or just over 10 million. Hers were in the 30 percentile. That means they were only 30% accurate because of multiple reasons. You guys, don't just trust someone to do your books. Make sure that they're being done properly and have checks and balances. We have horror stories that we can do another time about, how to protect from embezzling and all those kind of things. But the bottom line is make sure that you have real-time bookkeeping, because you can't do the tax strategies that Alexis is talking about if you don't know where your numbers are. You can't file your taxes on time if you don't know where your numbers are. And you can't grow your profit and grow your wealth if you don't know where your numbers are.
Right. And that is so true. That is true. And just to add, like sometimes just even going through the statements, if you're not looking at them, you can get overcharged on subscriptions or fraud. I know I've done bookkeeping for myself and gone through my stuff. I'm like, what is this? And I have to call the bank. I'm like, somebody's using my card. So you miss out on things to that nature as well. So it's just important that you touch your financials and you're looking and you're categorizing, or someone is on your behalf, not you, so that you can catch those things as well.
Yes, absolutely. All right. So let's wrap this up with a few takeaways. First thing is make sure that your business is set up as a business and that it is separate than you, and that you have the right entity structure and the right tax structure so that you're protected both asset-wise and tax-wise, and that you understand that and you handle it properly. We've got other episodes on how to do all that, but make sure that you have the right business type. Another thing is make sure that you have real-time bookkeeping. Someone, hopefully not you as the entrepreneur, needs to be tracking your numbers in real time, giving you reports, and you need to have checks and balances to make sure, like Alexis says, you're not getting charged for things that aren't actually you. And then third is you need to have a tax strategy in place. There's a big difference between just a tax professional who keeps you compliant with the IRS and files your tax return, but a tax strategist is a proactive approach. Is someone that you meet with throughout the year who understands your business goals, who is helping you succeed in business and pay less in taxes and grow your personal wealth. Make sure those things are in place and you can soar in your business. Alexis, is there any last piece of advice that you have for us today?
I definitely just want to add one of the things that we didn't touch on with a deduction is depreciation. So keeping that in mind, and if you don't have any books, a lot of times that may be missed because you don't have a balance sheet, of course, right? So just being aware of assets. Like if you're buying a business car, that's an asset. You get depreciation, large equipment, anything I say that's kind of equipment or supply wise, that's over threshold I usually use is 2,500. You want to be able to get that into service. And that's a whole nother conversation for another day, but definitely depreciation. So that's another reason why it's important to have books as well, because you can have that stuff listed and we can have visibility on it. But other than that, that's all.
I love it. I love it. All right, business owners, that is all for today's episode of Pivot to Profit. We would love to help you keep more of your hard-earned money. Just go to pamjordan.com. Schedule a call with our team. Alexis has a team of amazing tax strategists that'll help you. We've got bookkeepers, we've got fractional CFOs. We are here to help you up-level your business, scale profitably, and build freedom of time and money. Be sure that you have subscribed to Apple Podcast, Spotify, YouTube, or wherever you're listening. Feel free to leave a review. We'd love those. And remember, it's not what you make that matters. It's what you keep. We'll see you next time on the Pivot to Profit podcast.